In this video, we're going to discuss financial securities. What are they and why are they important? First, the dictionary definition. A financial security is a certificate that has monetary value that is negotiable. Securities are interchangeable and confer upon the holder, also known as the investor, rights depending on the type of the security. Broadly, there are three types of financial securities. There's equity, also known as stocks or shares, debt, which includes loans, bonds, and commercial paper, and derivative securities, which have prices that depend on other equity or debt or derivative securities. Equity securities represent ownership interest in the issuing company. Holders of equity can therefore be thought of as part owners of that company. Owners are entitled to profits, which are delivered through dividends. A dividend is a distribution of money to all owners, i.e. shareholders, and is typically distributed on a per share basis. For example, if you held 100 shares in a company and they issued a 10-cent dividend per share, you would receive $10. The other people in this example would get $15, and this person would get $1. So as you can see, the dividends are distributed equally among all shareholders. Note that companies are not obliged to issue dividends. That is, they don't have to, especially if they don't have any profits, or if they feel that there's a better use of that money, like funding a new project. Owners of a company also can influence how that company does business through proxy voting. Proxy voting is when shareholders cast one vote per share to elect directors who sit on the board of directors and vote on big picture items like CEO compensation plans, mergers and acquisitions, and even in some cases, activities like corporate social responsibility. Debt securities encompass bank loans, corporate bonds, government bonds. By the way, in the US, these are referred to as treasury securities, commercial paper, and others. In general, a debt security establishes a relationship where the investor, also known as a creditor, lends money to the issuer and is repaid in full plus interest. For example, the issuer, in this case the corporation, issues a bond worth $100 million, consisting of 100,000 individual bonds worth $1,000 each. That means an investor will pay $1,000 up front and give the 1,000, which then flows back to the company. And in exchange, the company agrees that it will pay back the $1,000 at the end of the term of the loan, and it will also pay interest, also called the coupon rate. By the way, the coupon rate is so named because back in the days when there were still paper bonds, there used to be little coupons attached to the bottom of the bond that you would tear off and deliver to the corporation, and in exchange for handing over the coupon, you would get that 7% or whatever the interest rate is. And because you could resell these debt securities, the company didn't really care to whom they were paying out the 7%. It's just whoever had that coupon for that 7% payment. By the way, 7% is 7% of the 100 million divided by that 100,000. So basically 7% of $1,000. So each of these coupons is worth $70. Once all the coupons have been paid, typically the whole amount is paid back in full. So the investor will have received $1,000 plus all the cumulative coupons throughout the term of the loan. Different types of bonds with different types of schedules exist, but all have the basic similar concept. The interest rate, by the way, depends on a few factors like the length of the loan, the term, which I've referred to a couple of times, and the credit worthiness of the borrower. That is, if the borrower has in the past defaulted on a loan or in some way seemed unsavory to the market, chances are they're going to be paying a higher interest rate than someone who pays all his loans on time, much the same as you might pay more or less depending on your credit worthiness for a mortgage. Derivative securities are things like forwards, futures, options, and swaps. This is the broadest class of security and encompasses many different subtypes. Typically, derivative securities are complex. They involve leverage, which we'll definitely get into at another time. They involve interest, which we discussed just now briefly, and in some cases, advanced calculus. For example, commodities like crude oil, gold, and soybeans are traded through derivative contracts, for example, futures and forwards, where the price of the derivative is tied to the price of the commodity. However, derivatives are not strictly limited to commodities. They can be created on the basis of any other securities, even other derivatives. One of the more common types of derivative securities you might have heard about is a stock option. And again, these securities are beyond the scope of this series, and we will discuss them at length in more advanced videos. In general, financial securities form the basis of the modern financial market, and they are regulated by various agencies in the U.S., including the SEC, FINRA, and the CFTC.